Now I'd like to welcome our distinguished retail panel to the stage. Our moderator will be Heather Bogdan from a retail specialist with Legend Partners. And then our panelists will be Bryce Blanchard as Principal Executive VP of Newmark Knight Frank, Stuart Thane, Executive Vice President of Colliers International, Robert Booth, Director of Development with Wadsworth Development Group, and Eric Stratford, Director of Business Development and Pre-Construction at R&O Construction. It's yours.
Awesome. I want to actually start out, before I introduce my panel, with a question that someone asked me. A colleague of mine, John Taylor, said, "Wow, Vivint Arena? That's, a great venue. Why did you move Symposium there?" I said, "Gosh, John, I actually don't know the answer to that." And he said, "Oh, wait. It's so that all the people involved in real estate and their egos can fit in the same building at the same time." Thanks, John. So we decided to have someone from the retailer, tenant representation, and construction, investment, and a developer to get everyone's perspective instead of just one. So I'd like to introduce Stuart Thane. Raise your hand. He was homecoming king, and he wanted to be an emergency room doctor before he got into commercial real estate. Robert Booth. Raise your hand. He actually survived a hit to the back of the head with a sledgehammer, and if you like gore, look him up, because it is heinous. Eric Stratford only uses Peachy Peach air fresheners in his truck, and he got to meet the fire chief in junior high. I believe Molotov cocktails are illegal now, right?
They are.
Okay. And then Bryce Blanchard, here. He has 4 amateur World Series titles, and I didn't know this was a thing, but Bryce is actually an internationally ranked Scrabble player. Yeah.
Woo, I like
So,
it.
welcome. Thanks, audience. Let's get started. What kind of retail deals are being done these days, and what's different of how they're getting done compared to 4 or 5 years ago?
Good ones. Yeah. Are being done. I think it's changed a little bit. 4 or 5 years ago, we had the e-commerce thing. That bricks and mortar was going to be gone, and everything was being done over the internet. I think that's now changed, obviously. I think all the bricks and mortar stores have figured out how to deal with the e-commerce business, and that the e-commerce companies are now doing bricks and mortar stores. And so I think as far as the deal structure and all that, it's pretty much the same as what we've done. There's not as many tenants as we had 20 years ago when we had 3 tenants in every category, and you could get great rents, those types of things. But myself, I just haven't seen a whole lot of change. We're seeing a little bit on co-tenancy these days because you don't have the Targets and Walmarts of the world that are that active coming into these centers. We continue to see lease rates go up on the QSR type restaurant tenants. You're seeing some of the big guys pay real money for the land and getting some subsidies. But the nice thing about it is that for us here in Utah, I think almost everybody we represent and that's here in the market is actively out looking at other deals, except maybe Target and Walmart and a couple of those guys. But Costco is doing several new deals. They continue to just do incredible here in our market, and they'll continue to look. Once they hit a certain threshold in every warehouse, they can't do any more business, so they look to open another warehouse. So, I view deals being somewhat the same format as they've been over the years. So,
I can give you my perspective. Is this on?
Oh.
Hello. All right. I can give you from a developer perspective. Hello.
Maybe I can talk for a second while they're working on your mic. But from my perspective on the construction side of things, I went back and I looked at what happened 5 years ago as far as what deals we were looking at, and I was really shocked because I thought that I had a lot less
positive perspective on where we're at today than where we really are. If you look back, for us as a company, 5 years ago, we looked at about $335 million worth of retail opportunities in that year. And I would have thought it would have been a lot lower in 2019, but really it was only about 20% lower, around $250 million worth of retail. The only thing that's really changed, and to kind of back what Stuart was saying, is just the type of product that we're doing. Back then there were some big and mid-box type stuff, and now it's a lot more grocery, remodel, refresh, restaurants, those gas stations, convenience, those types of things. So that's what we're seeing from the construction side.
Let's see if this works. Okay. So from my perspective, which is the developer perspective and the lens that I see the world through, I think you need to break the retail world up into, the big box and junior box world, and then maybe the pad users and shop users, because I think the answer might be be different for those. But 5 years ago we were very bullish, in fact, gung-ho at developing large big box retail centers and 100,000 square foot plus, anchors, and we're successful in developing a couple centers, and we got burned on a couple centers. We went down the road with some big boxes, got all the way to the closing table where they were a shadow anchor, and the deal dies. We end up backfilling them with another 100,000 square foot user to go down the road with them, and the deal dies again because of some of the trade with China, which had a real impact on that retailer. And so I think I echo what the other two panelists have said, in that the number of boxes out there today just aren't as many as there used to be who are expanding. And that goes for certainly the big anchor boxes, but also the junior boxes. And so I think it's increasingly difficult in today's environment from a retail perspective to do big box retail, non-mixed use development. And so we are finding that as a challenge, but I do think the deals are happening. Stu can speak to, the discount retailers, the Rosses, the TJs, those are still expanding. We've seen entertainment be a folks backfilling and becoming the new anchors at certain centers. And then lastly, as it relates to the small shop, I think the food users are the guys who are the kings.
Right. So I'd like to interject, and actually, Vinny, if you can hear me, if you can get this slide on retail openings and closures. I couldn't get that to show up. But we are seeing negative, on closings on soft goods and large retailers and department stores. And I'll give you the statistics. In 2017 to 2019, there were 4,000 openings and 14,000 closures. So negative 9,000. But wait, don't cry. It's going to be okay. Retail, entertainment, restaurants, specialty stores, openings 45,000, closings 28,000. So it's a growth of 18,000. So we're still in the plus. It's just that adjustment. Okay, I know I'm the moderator, so I'll give it back to you guys.
No, I agree. It's that big box world versus the small shop and pad users, right?
Yeah. I don't think they got the slide, but let's go on. Hey, Stuart, I'm going to actually ask you specifically, what do you think the hottest submarkets are right now in Utah?
Well, I thought about, is this working? I thought about that, and as I just talked about, it's different than what it was 20 years ago, where a hot market would be 350 to 500,000 square foot centers, those types of things. So it's changed a bit. But right now we currently have at least 2 or 3 deals going in all these markets. St. George, Washington counties, I think, is going to blow up. There's a couple of big proposed projects down there. You got Spanish Fork that's going to continue to grow. You've got University Avenue in Provo that's going to continue to grow and seeing new tenants. You've got University Place with the mall. You've got Vineyard. You've got Pleasant Grove that continues to grow. You've got American Fork, where they're seeing some backfill and some additional new tenants in the mid-sized box going in there. You got Lehigh that you're going to see some new development. You got Saratoga Springs that you're going to see just, I think, blow up with the addition of the new Costco out there. You've got Harriman, you've got Riverton, you've got Sandy, you've got Fort Union, South Jordan.
Wait, I think you've named the whole state.
Well, and part of my point is that I think that, you know, it's not like just Sandy's hot, but there's certain geographic areas in almost every city, because the growth that's happening in our market as a whole, as a state, is bidding for these type of developments to happen. Now, the type of developments that are happening are different than what I mentioned, you know, 20 years ago, where we were building, you know, 350 to, you know, 800,000 square foot centers. Now you're seeing, you know, 2 to 8 acre type deals built to where you have 100,000 feet of retail almost as a max now, driven by 2 or 3 mid-sized box tenants, and then the QSRs, which are the hottest thing going, and obviously in the state of Utah right now. And you surround that with them. And all those markets have it. Riverdale Road, you know, what's going on up there, and some of the new things that's going to be taking place there. Farmington, you continue to see that grow with Station Park and what's happened there, and then the new development that's going to happen kind of to the northwest of that. So I'm pretty bullish on all of these markets, because we have regional and national tenants that are looking within those areas that are going to be developed. And again, they're not these huge centers, but they're really epicenters within these small communities. They're going to allow it to continue to grow, and see some of these tenants that haven't looked at those markets forever start going into those markets, which I think is a great thing, obviously, as these tenants still need to grow. And some of these, like Ross and TJ and those guys, still want to do 100, 120 stores a year. In order to do that, they got to start looking at some of these other markets. And I think some of the markets here, like Tooele, we're going to see some things happen out there, I think, in the next year that's going to be pretty cool. So I mean, that's what I would view as the hot spots. And it's different, again, than what it was a long time ago. But, you know, we're seeing activity in all those markets. And I think you're going to see some cool projects being done. So, and I forgot one, downtown, which will be interesting to see, you know, what happens. And interesting projects for me is Cottonwood Mall, what happens to the prison site, what happens out on Mountain View Corridor, where the group of tenants, when they decide to go, where they end up going. And then what, you know, again, what happens downtown with the way, you know, multifamily development's going, what they're requiring to do with some of the retail on the bottom floors, and how all that plays out. It's going to be interesting to see over the next few years.
So on that, I'm going to actually skip around some of my order on questions. It's easy to recognize the boom in our city. You walk downtown or come to Vivint, you see all the people around. What are your thoughts on urban ground floor retail? Because Utahns typically haven't liked that. They don't know how to not park nose in. So does somebody want to address what your thoughts are on urban ground retail?
Well,
Okay, you think about that, and I'm going to ask a different question. Think about that for just a minute. So who are the buyers in Utah? Hot markets, who are the buyers?
Heather, on that. Just anecdotally, last year I sold the Cliff Building on the corner of Main and Broadway, historic creative office building. And while we were under contract with that to Fortress, Bank of America showed up as a ground floor urban retailer, and we were able to cut a deal there. I didn't do the leasing, but as part of the capital markets transaction, I had a hand in it, and Bank of America shows up with a $55 retail rent to buy that corner on Broadway and Main, which set a high watermark. So there's definitely another project I'm working right now on Broadway and State. And Ginger Street just came in on the corner of that building to create additional amenities. And I think with the additional developments that are going on in State Street, you're going to see that corridor continue to fill in like Main Street has. I think ground floor retail's got a real story for downtown.
I just think it depends on where it's located. And if there's the pedestrian traffic, I think the farther you get away from the CBD, the tougher it gets. Even though you've got, scooters now, you got bikes, you got all those types of things. But I think within the CBD, I think it makes sense. It scares me to death once you get outside of that, a block or two, just because it really limits the people and the traffic that's going to go there. Plus the tenants that are going to go in those first floor levels, what means that you're not going to go to the CBD because of the proximity of that. So I think we're still, in my opinion, a little ways away from seeing kind of on the outskirts of downtown with the first floor retail. I think it's going to take some time.
Well,
And
I-
those are of you from Denver, CBD doesn't mean CBD, it means Central Business District. Just wanted to clarify that.
Hey, we have CBD in Utah now. Come
At
on.
least for another
Okay,
week.
I was just trying to keep it.
So,
I was just trying to keep it clean.
One of the points that I want to make with that though too is construction costs typically are they're more expensive on that type of a structure than a ground up retail. And like for example, I went back and ran some numbers. A few years back, we did the Station Park project up there in Farmington, and we had the ground up retail buildings that we built, and I compared those costs versus like the Hyatt Hotel that was there that had a ground level retail. And between that and a couple other projects, you're looking at 6 to 10% more on just structure costs just because of the way that the structure is built and designed. So that eats into your ability to lease those out and turn a profit.
Well, my experience also is that parking, the tenants that can afford those rents are typically nationals or regionals that have to check every single box to qualify to pay those rents. So how do we get the smaller people, smaller mom and pops or the unique restaurants or boutiques? How do we get that to pencil?
I think it's tough. We've just done our first foray into multifamily downtown, and we've got 3,000 square feet of shop space down in the basement. And you want to make sure that certainly the tenant is accretive to the bottom line and to the investor, but also, we want to make sure that the tenant is accretive to the mission of what you're trying to achieve from a marketing perspective. And sometimes, those big nationals are not the guys that fulfill that mission, but they're the guys that can fulfill that rent. So we're feeling that dichotomy right now.
Actually, I leased that project.
I know,
so
you know what I'm talking about.
2,000-ish square feet, 4th East, 4th South. Give me a call. Heather Bogdan. Hey, Bryce. So who are the buyers in the retail market? I know that Office addressed that a little
Yeah,
bit. Can
it's
you?
different for retail, and I sell a fair amount of industrial, office, and retail equally. And I would say, particularly in the retail sector, what we saw last year was almost all the players in the space were one-off 1031 buyers and private family offices. There was virtually no institutional capital that made a big splash in transactions in Utah. And if I asked everybody to guess which state in the country most of those private requirements are coming from and buying Utah real estate outside of our homegrown capital, I imagine everyone here in the audience could guess that state. So
North Dakota?
yeah, exactly. No, South Dakota. But, it's California. So I talk about a jet stream of capital that flows up here from California as a result of the arbitrage that's available in cash flow. And that was the case in retail. And there's some contrarians out there that even though, as we heard from Darren, the retail sector has the least amount of appreciation. Well, if you're a buyer, you oftentimes want to find something that's maybe out of favor with the big money. And so we found private buyers shopping in aisles of the grocery store, so to speak, here in Utah, where others had kind of let those areas go cold. So even unanchored strip centers last year, I did 8 deals in retail last year, and of those 8, 5 were California buyers, and 3 were from Utah. So that's kind of the buyer profile right now.
And so what are the trends with cap rates on that?
Yeah, cap rates. I like to take the retail market into 2 different tranches. Single tenant, we set an all-time low, a blended cap rate of 6.2% last year. That was a compression of another 28 bips from the year before. And for the great single tenant deals, you're seeing lots of 5 caps, even some comps that have pierced below 5, which is pretty crazy. But people compare them to bond yields and say, well, we've got depreciation, we've got rent growth. So there's still pools of capital that those pencil for. On the multi-tenant side of things, we saw for the first time in the market's history our average cap rate go below 7 to 6.88. Again, a slight compression from last year. And that was on relative volumes of 48 single-tenant deals and 70-plus multi-tenant deals.
Awesome. So, audience, I want to ask you. We hear over and over about construction costs and changes, and so I want you guys, and you have to participate, or I have this laser pointer, and I'll call you out for not participating. So I'm watching you. I'm going to count to 5, and I want you to tell me how much increase or no increase you think construction costs have gone up in the last 4 years. So if you think it's 0, if you think it's 2%, if you think it's more than 10, flash. So on 5, let's do this. Ready? 1, 2, 3, 4, 5. All right. I saw a couple of flashers. I don't think I saw any 0. Maybe I saw 1 0. Do you want to address?
I saw a lot of 10s. I saw a lot of 10s
I did too.
out there.
I did see a lot of 10s.
It was like no even question. It was like they were ready. It was 10s. I would have thought that too, and from what I hear from you guys when you're trying to put deals together, I'm always the bad guy because I'm delivering the bad news. Yeah, construction costs more. I don't think it's quite as high as you think it is, but understand, go back to, I think we're all living with Uncle Rico in the glory days, right? We're back there throwing the football around and living in the high school arena, and we really need to come to what's happening today. If you look back from the downturn and when it started to kind of come back, there were 4 or 5 good years of really aggressive construction pricing, and then the market started to catch up, and since then, I went back and kind of ran some numbers just for us internally, and it's probably more in the 2 to 4% range, even though I've heard a lot of economists say it's been 6 to 7 or 8. So from my standpoint, since about 2013-14, it's probably gone up about 2 to 4% year over year would be my best.
We can get a line and get that in writing from him after. He'll be on the stage left. So 2% essentially.
2 to 4.
2 to 4.
Okay.
Any of you agree, disagree? I'd like to ask you as a
Robert's
developer. I know, we could arm
reeling in
wrestle.
his
This little
seat.
table's doing nothing. We can have an arm wrestle right here about this.
Yeah. From my perspective, not all projects are created equal, so it's hard because I'm not bidding steel to steel or, masonry to masonry or wood to wood. But from a project perspective, you bid projects that you did one area and you bid a similar size project next, and I've seen costs go up down the road a couple years later, and there's for us, granted it's not the exact same project, but we're in the same market, and costs were significantly greater depending on, so this is a project out of state, but
yeah, I really think it's hard to pinpoint, I mean, that's why I say average overall, it could be around that area. You're right. There's so many nuances with sites and everything that it's really hard to pinpoint. And the best time to build is always right now, right? I mean, if you wait any longer, pricing it's just going to go up.
So other than construction costs, I'd like to ask the panel just overall, where are you seeing pinch points happen on deals?
Well, let me go back to that. I'll answer both questions. Thinking about pinch points, and I'm just thinking of an example. So certainly pinch points in making deals happen. The real estate development world, which is the world I live in, it's a fairly simple equation. You've got land prices, you've got site costs and building costs, and then on the other side you've got the rents, and what does that yield look like, right? And so within that equation, there are pinch points. We developed a center in Midvale. To go back, to give you an example, we developed a center in Midvale where we had small shops. We were 6,000 square foot shops. We built those buildings, core and shell, for $85 to $95 a square foot. And that's warm gray shell, HVAC unit on top, no distribution, and we give an allowance to the tenant. That's 4.5 years ago. Today, same pricing. That's $125 a foot. So what is that? A 35% increase in cost during that time. On the rent side of the equation, though, we're looking at $31 from the rent, 32 maybe. In today's equation, we're looking at $38, $39, and so I think the pinch points is that, and that's an increase of about 25%. So the pinch point from a developer perspective is that the yield is just being compressed, your margin's being compressed, so you're being forced to say, do I want to do this deal? Do I want to accept a lower return, or do I wait for the guy who Kids going to pay me $40, $45 out there. And certainly those users are out there, but not every retailer, and you can't plan every development around everybody being able to pay that freight. And so that is certainly a pinch point in being able to do development.
I'll interrupt. I know that we're still proving ourselves as a state. And so, hey, yeah, $50 a foot, we pay that all the time in California, but this is just Utah. So I think we have a lot of growing up to do, other than outside of the regional malls. I think your types of projects, we need to prove that they are going to be profitable to these retailers.
Yeah, and the retailers have to get comfortable with paying rents, and in some cases that happens. Certainly with the food guys, they've been able to pay that freight because that's where the traffic is generated. And other retailers, especially mom and pops, if you're talking shops, it's a little more difficult for them to swallow that rent. I think one of the other difficulties, talking about the cost equation, is in the land. And we live in a valley here with limited resources as it relates to the land. I don't know how many years it's going to be, 10, 15 years before we run out of land. And so there's land scarcity here, and so that drives prices also into the equation. My brother told me a joke the other day about a listing broker sitting down with the landowner to list his property, and the listing broker sits down and says, "All right, landowner, let's get this started. Why don't we sit down? You can tell me what you think your property's worth. We'll both have a good laugh, and then we'll move on from there." I think there's truth to that, and in many cases, the landowners are getting their prices because of that land scarcity.
Yeah. Anybody want to add to that?
Maybe from the construction side, the pinch points, and it's been mentioned in the office, the labor market with the construction, but I want to talk a little bit, just for a minute, on construction materials. Think about this for just a minute. I read somewhere that lumber, 33% of lumber is imported, 90% of aluminum, and 33% of our steel is imported into our country. And so when we start talking about those geopolitical things that Darren was talking about earlier, it really starts to affect, and that's why you can see those acute big bumps on some of these things, that Robert was talking about on construction costs. You're going to see some of that, and that can be a pinch point.
I think from the perspective of the tenant side of it, I think our land costs here, because of the mountains and the lakes, we're seeing numbers in downtown that are exorbitant, $70, $80, $120, $180, $200 a foot now for land. Obviously, retailers can't pay those kind of freights, even the Chick-fil-A's of the world. And so I think land costs for some of these retailers and developers are becoming a bit of an issue. I think cities are having to help a little bit in regards to where they put it in a CDA and RDA, whatever, to help get some of those costs down. Part of the issue is just the volumes that these retailers can do in our market. And it all stems for them. They'll pay what they can based upon the sales that they project on that location. And when you take construction costs, land costs, throw it all into a pile, this is what we can pay. And in the market, and sometimes we're seeing today to where, we were working on a deal with Heather, and we had what I think one of the better QSRs in the country that does in excess of $4.5 million. They couldn't make the numbers work on a deal downtown, and so they passed on it. We're seeing those things happen. A couple of Chick-fil-A deals, we're seeing that happen. We're seeing numbers in some of these small markets in the $30 a foot range. That 5, 6, 8 years ago you could have bought it for $2 or $3. So that is all part of it. But for us, I see that being probably the biggest pinch point. The issue is you've got multifamily guys that'll come in and pay the freight because they can go up and retail single level and so it'll be interesting to see what the future holds in regards to how we deal with the land values.
So, Bryce, I want to ask this directly to you. Compare 2019 to prior years in investment sales volumes.
At this point, Heather, I don't want to bore you with statistics. We went down from 540 million to 400 million, with the bottleneck being just fewer deals available for buyers or deals that weren't properly underwritten, taking to market mispriced. Let me answer a more interesting question, which I think's coming because I know we're getting
Yes.
a little lower on time. And that is, what's going on with retail centers that are struggling with vacancies? And I have three kind of examples of things that I've seen happen that to me are pretty compelling and I think might plant some creative juices in the minds of the audience. And like Jamie, I'm pretty excited to be here. I'd rather talk about the jazz and real estate, quite frankly. And I'm hoping to get out of the building. Normally, as Travis Healy might be able to attest, I'm trying to get out of the building without being warned by security at least once today. So that's my personal goal. So I'm going to try to keep it clean up here. I was hired by Sportsman's Warehouse to relocate their office headquarters. They were in Midvale in a leased building. I counseled with the CEO and I said, why don't we get creative and why don't we look to buy a piece of real estate? And he said, well, we don't really want to own real estate. I said, that's fine, we can flip it, you can make money. Just sign a long-term lease. And so we commenced on a search, and we looked for office buildings, but what we found was an underutilized retail building that my friend Rich Robbins had in West Jordan. 71,000 square feet, dinosaur kind of property for retail now, struggling with vacancy. Granite Furniture had been going out of business for, I think, about 14 years straight. And we went in there and we negotiated that, and with the help of West Jordan City, we were able to take what was a retail albatross in a dying little submarket there. Fred Meyer had closed across the street, and we brought a publicly traded NASDAQ corporate headquarters to West Jordan, Utah. We paid $1 per square foot. That was a basis play that allowed us to then TI it, make it something cool, and then we could flip that thing to a single-tenant net REIT, and Sportsman's Warehouse could tuck that money in their pockets. They didn't even think like that. So that's an exciting way for us to repurpose real estate, retail real estate, whose time maybe has gone by based on floor plans, and those big parking fields are huge. Another example is I'm involved with a project called Legacy Plaza at 54th. And that particular property did very well with the paths, very well with the shop space, but there was 4 acres designed and planned for mid-box. Well, guess how many mid-box deals had been done there? Troy Hardy, how many? 0. Thank you, Troy. So what do you do? What do you do with 4 acres in the middle of a great metro area with no mid-box willing to come? Well, we huddled with Taylorsville City. We decided to put together a joint venture, and like Stuart said, we go vertical. We get Cowboy partners and we say, let's do a JV. We'll still do some retail on the ground floor, but let's go up. Taylorsville City gets on board. We make the deal. A third example, I'm working with Ben Brown, my friends over at Mountain West Retail. We've got a deal up in Logan we're doing. I'm selling grocery anchor retail. What's the most important component of underwriting a grocery anchor retail center? The grocer, right? While we're under contract, the grocer says in the Logan paper, we're going dark. Thanks, Macy's. There goes my deal, right? That's a deal killer. The grocer's going dark. We were able to get the deal done and closed without a pricing retrade because we had a contingency plan to backfill the grocer if their store sales in their future didn't happen with fitness. And so these are creative things that as owners of retail centers, you don't have to just stay in the box. In fact, let's think outside the box, because to my panelists' point about land constraint, these retail centers at the end of the day, as we look back 10, 20 years from now, are gonna look like little infill gold mines if we can think outside the box and repurpose and find highest and best use. So retail's still alive. There's buyers that want it. There's tenants that can repurpose it. We just have to continue to be creative as a marketplace.
I think it's great, though, kind of what's happened. We talked 15, 20 years ago about Kmart and Sears and all those guys. I think it's opened up real estate that's been tied up for 50 years in certain markets. And yeah, there's some Shopkos and that are located maybe a little too far east or west and those kind of things, but they'll all get repurposed. But the majority of them end up going to, retailers. And I think it's been great for our business because we've seen tenants come in here that wouldn't without having that, but it's opened up a lot of unbelievable real estate that we've been able to lease up with better tenants than, not that Kmart and Shopko aren't, but them. So.
Well, they're not open, so there's that. I guess we'll turn it to the audience
We are
for
turning
questions.
Absolutely. So we have quite a few questions that have come in. Please continue to ask the questions via text. First one, and this kind of goes along with some of the things that were just said. Retail has been going through quite an evolution. What happens in a downturn, and what belt buckles are going to be tightened? What's going to change?
Retail is going to continue to shift. It has for the last number of years. I think it will continue to shift. In the downturn, from our perspective, from a developer perspective and where we sit in the cycle, we're cautiously optimistic about retail. Maybe not as bullish as it relates to the big box development. Certainly as it relates to pads, credited tenants, well-located retail, we're very bullish. And then, as it relates to the downturn and those boxes becoming vacant, we've done exactly what these two were talking about, which is we're looking at alternative use. We're looking at rezoning what was stuff designated to be retail, and we're looking at alternative uses, saying, can we do something that's higher and better now and going vertical?
So with those changes and trying to mix things up a little bit, there's several questions on here about how mixed use is going to be involved with retail and how that's going to be incorporated and when.
I think it's happening now. I think you're going to see that become more a part of retail development, that a lot of it's going to be mixed use. I believe it has to be when we go back and talk about our land costs here, because I don't think they're going to go down because we're running out of it. So I think there's going to be mixed use in most of it. And I think retailers now are starting to buy into that a lot more across the country, to do those types of things and realize that it's all about the number of people within a certain proximity of their store. And so I think you're going to continue to see more and more of that be developed.
I do think, though, that there's some challenges that we have to overcome. We've talked about, parking and what it costs to park. I mean, you're probably 3 times more to park in a podium level parking than an on-grade type deal, at least 3 times more. So there's some challenges associated with that. But as we grow and as we as a community and as we learn to adapt to some of that, I think the retailers are going to have to see that too.
For many years, mixed use became kind of a hiss and a byword out there in the lender community and equity guys. And I would say, Kip mentioned earlier what's going on with the granary, and I would agree with him. And I think as you continue even to go south of the granary, I'm involved with a project called South City in South Salt Lake, and that's a good example of mixed use. It's gonna be on the map. It's right where those freeways connect, and South Salt Lake is gonna gentrify as well. And that's a mixed use project that's my friends at Gardner Batt are putting on, and it's gonna go famously well. They've got plenty of demand. There's no need to spec right now. The tenants are ready to go, and cities are on board with that kind of stuff. They want to see that, and there's demand for the mixed-use projects in a way that wasn't the case years ago.
I think proof is in the pudding. We have to educate the retailers that they don't need 145 dedicated parking stalls. But right now, that doesn't check the box for
Can you
Utah.
tell that to your tenant that I'm trying to do deals with?
I think that tenant only needs 138. So, and cities are saying, hey, this is an overparked project, and it is by code, but not according to the retailer. So education of the retailers, I think, is a big key for making these mixed-use projects.
And I think part of it depends on who the tenant is. I mean, Costco now requires 20 acres and 900 parking stalls that are 10 feet because of the volumes they're doing here. So it all depends on who the retailer is and the kind of volumes that they do. I know cities now are trying to cut down to 2 per 1,000 square feet on parking stalls, and it's tough to do with retail these days, especially all of us, because we want to drive in, drive up front, run in, pick it up, run back to the car and get out of there. We don't want to park in a structure and take 10 minutes to get there and sit down and eat. I mean, none of us have any time, I guess, but that's kind of the way it's going. But it's interesting that it all depends on who the retailers are, because it'll be interesting to see what happens. But Costco just keeps blowing and going in our market, and that's all. We're 3 or 4 of the other deals we're looking for land or for parking.
I spend way too much money at Costco.
Thank you.
So what do you guys see as the ideal square footage for retail in downtown markets?
I don't know how you respond. It depends on the number of people down there. I think we're still in our infancy in regards to the population that's downtown right now, compared to Portland and some of the other markets. And so I don't know if there's an actual number, but I think you go back and talk about some of the land costs you start getting 100, 125 bucks a foot, you may start seeing retail that'll be interesting to be developed where they have their parking underneath the store and they go up a couple levels. So it'll be interesting to see. And some of them are doing that in Montreal and others said in New York, those kind of places. So I don't know what the...
Drones. We need drones to drop us off and take us up.
So with the population growing as fast as it is, and grocers few grocers are expanding, what do you see as the future for grocery?
I think grocery will continue to expand. I mean, people need to buy groceries, right? So, but there has been a brick thrown into the grocery market. You know, when Amazon bought Whole Foods, you had a bunch of the big nationals that you know took a pause, and that's happened locally. So I think there's selective grocers who are continuing to expand, and that'll happen. But it's going to be well thought out, and maybe those centers look slightly different, and some of the formats of those stores, instead of being the 100,000 square feet, maybe or the 65,000 square feet, you have some of those smaller 30, 40, 45,000 square foot grocers coming. It'll still continue, but maybe in a different format.
So you guys have mentioned Shopko and Kmart, those vacancies. Speaking on those, what is the ideas for repurposing those buildings?
Well, Bryce addressed that a little bit with outside of thinking with that corporate headquarters, but I'd be interested to hear others.
Repurposing, I think Shopko's and Kmart's is what's fueled a lot of Stu's bank account, going out, because he's representing those tenants that are backfilling those guys. The Rosses, those are the, I think it's been in somewhat a godsend to some of those retailers who are still expanding, who are mid-box guys who want to pay infill, kind of backfill rents versus, if I get a quote from a TJ Maxx and I get their prototype and I have to go ground up now, it's hard to make that deal work from a ground up perspective. So I think backfilling that space is, there are retailers who will do that. Our portfolio right now is fairly occupied, but we have targeted to buy vacant boxes, and we've been successful in filling them up with consignment, the Goodwills and fitness, which was already mentioned. We've had some success there.
Other markets also are doing cool food courts. I'm reading about. I haven't seen that as much yet in Utah, but that's another way to get people to congregate. People want experience retail. They want entertainment. They want fitness, medical, things that are internet proof, that are experience-based, food, social. The social aspect of retailing is something that I think is a key driver in how to repurpose the areas that have vacancy issues across our market.
And I think it all goes back to, again, where they're located. We're seeing storage units go in a lot of these now, too, that are off the dime a little bit, that seem to be working pretty well. So, hey, location still comes back for retail. The better the location, the more opportunity to do retail and to revitalize it. I think we're going to see that with a lot of these big centers. You're going to see that happen. So
I think from my perspective, it's a divide and conquer. I get a phone call a week, it seems, on, hey, can you price this big box? We're going to divide it up and repurpose it this way. So it's a divide and conquer type of thing.
For sure.
Heather,
So we're out of time.
Yes, we are.
Thank you, audience, for your questions. Great panel, awesome audience. I do want to say that in Utah, this is an ICSC statistic, International Council of Shopping Centers, that there are $53 billion in retail sales in Utah. So it's vital to our economy. So please spend, experience, eat, shop, play. Don't do it for yourself. Do it for the economy. Thank you so much.
Thank you, retail panel.